I got a call. Yeah. Hey. Got so many shades they thought I had a lazy eye. Shorty rolled me smooth as my Mercedes ride. No love, cry when only babies die.
Alright, yes guys, welcome back to another YouTube video. This is the first one filming in Tulum, Mexico. I'm so locked in right now, it's crazy. You guys wouldn't understand because if you've been watching my Instagram over the past year, 2 years, you know I've been going to a new country, a new city. Every single 2 weeks, 3 weeks goes by, we're always flying out. But now I've finally decided it's time to lock in. It's time to stay in one place for 6 months. I know to some of you that may not sound like much of a task, much of a challenge, but to myself, I do get bored quickly. For those of you with ADHD, you will know what it's like. You always have to see something new every 2-3 weeks and have a little change of scenery, especially when you're getting all these payouts and the funds is coming into the bank. You got to change locations and switch it up real quick. So we're locked in. We're in Tulum, as you guys can see, in the middle of a fucking jungle right now. And let's get into this video. I'm going over the unicorn model. This is the model I trade and the only model I trade. We're going to be going over the key essential checklist that you must follow in order to identify a clean setup. Let's get straight into it. So before we dive into the model that I trade, the checklist, etc., going over very high probability trade examples on the charts, I'm going to tell you guys a little bit about myself. For those of you who are new to watching or have been watching for a little while, you already know the background story a little bit, but I worked many jobs, and this may relate to many of you watching this video. In fact, I used to work 12-hour shifts on a nighttime shift pattern as a security guard in the UK, and this was 7 days a week. No days off. We don't have days off. I've never had days off, whether I'm trading, whether I'm doing anything to do with business. Saturdays and Sundays are for losers who choose to have a selective day off. For me, I see the weekends as an opportunity to get ahead. Now 20 to 30 hours ahead of the average person who's relaxing over the weekend. I've now got more money and I'm 30 hours ahead going into the next week already. And I used to work, as you can see here, the picture of when I just started a night shift pattern for working with mental patients in the hospital. I used to tackle these patients to the floor. They'd be jumping out of the bed trying to like escape the room because they want to stand in the corridor and just look down the corridor for no reason. I have to tackle these people out. Sometimes I had people jumping out the window. You know how it goes. You just gotta take a few people out here and there. So I used to work for a Royal Mail company, as you guys probably are aware of the name, in the back of the lorry, where these packages are like 40 kg. If you ever received a package like a TV or a phone, it was either missing or damaged, well, it's because of me. Because I used to get these packages, and honestly, it was the only bit of entertainment I could possibly get out of the job by slam dunking these packages into the belt, which takes it round for everyone to sort. I get these packages and just go boom, you know, like that, and just blow the package up. It went everywhere. That was the only type of fun I could have out of these jobs because they was immensely boring. And I finally found ICT midway through working this job in the warehouse. So I used to walk around pushing the cages with an AirPod in, ICT playing with the 2022 mentorship. I used to sneak my phone out under my jacket, just watching. Every time I was not working, I used to come back at 7 AM, which I meant to sleep through the day, and I just stayed up for the markets. So I was sleeping probably 4 hours a day, drinking Red Bulls, Monster, anything to keep me awake. I was locked in because I knew there was a way out of this. And boom, what happened? Got my first payout and I blew all the accounts. I blew them all. Every single account got blown. I blew over 100 accounts. Trust me, I'm nothing new to blowing accounts. I've blown many prop firm evaluations, funded the lot, live accounts as well. And after that, I was in a dark place because I was still working. Yes, I received a $10,000 payout, but I told myself I needed the second payout in order to basically graduate from the job and leave the country for good. I wanted to prove to myself that I had consistency, and clearly I didn't, because I blew all the accounts straight after the first payout. It was all out of the window. And the main reason why I blew the accounts initially after the first payout was back in 2022, actually around mid-year, was mainly due to the fact of me not following my rules. Risk management, it wasn't even a thing after my first payout. I was trading outside of macro, I was trading before the New York session, after the New York session, during Asia, the lot. And as you guys can expect, trading like that, I blew a lot of accounts, and eventually after 4 months I came to conclusion that everything I was doing was wrong. I thought maybe the model wasn't working or the price action wasn't good, but I eventually realized that it was actually myself. And it's always going to be yourself. The price action's not bad, and even through the summer months you should be making money. Last summer in July I had a very big payout during the summer months. Just of the month of July, a 6-figure payout across all prop firms. So put that into perspective of just the summer months alone producing 6-figure months. So this is what is capable when you actually apply strategy, time and price together all in one, and you don't break your rules. But from this point, no one was ever gonna come save this guy in the back of the lorry. It had to be done by myself And same with you. No one's going to come across, hold your hand and bring you to the top. There is ways you can go about it by working with someone who's already at the top, say one-to-one, but at the end of the day, you still need to put in the majority of the work by yourself by watching the 2022, the Market Maker series, watching my videos on my channel, which are completely free on YouTube, and forward testing yourself. There's no point watching boxing fights of Mike Tyson expecting to throw combinations like Mike Tyson does without actually having any boxing experience. And it's the same with anything in life. You need real life experience in order to be good at trading. And the one thing that no one ever talks about, everyone talks about daily bias, they talk about strategy, they don't talk about this. Psychology, having patience, which everyone lacks, and discipline to wait for your model and to follow your rules. So, psychology. This is when you take a loss and you get back into a low probability trade, or there's no trade at all and you're just trying to gamble. That's psychology. You have to stop that ASAP. If you want to be profitable and make money, you have to fix your psychology tomorrow when the market opens. You have to do it. It's essential. Patience in your model. You wait for your requirements for the trade to be met and then you take the trade. You don't see a 9:30 open candle with a fair value gap and take that outside of macro because you believe it's going to go higher or lower. That is not a trade, and you guys know what a high probability trade looks like. Do not take low probability trades. You're going to take less trades, it's going to make you more money. More trades will likely either blow your account or lead you down the route of taking even more trades, and then psychology out of the window. And guess what's out of the window as well? Your accounts. So both of these go hand in hand, and they also go hand in hand with discipline. Discipline and patience is almost the same thing. You need discipline to follow your rules, and you need patience to get you to the next trade. So these are essential. If you're about actually making money and getting consistent payouts, then this is not even up for debate. And then for starters, people who think there's going to be 5 trades or a trade every single session or every single day, that's entirely not true. You can expect to only take around 1 to 2 solid A+ setups a week, which form in price on NQ, and that's the only pair that I trade. I don't trade ES, however, we monitor ES, and it's very vital that you do monitor both NQ and ES. Have the trading view split into 2 on your screen. Yes, you need to pay for premium on trading view, but that's the bare minimum. If you don't have the money to purchase evaluations and a premium version of trading view, then trading's not for you, because you need to work a job in order to actually afford to start forward testing. For people who don't even have $500 to their name, you need to get a job first, save $10,000, and then you can start approaching trading, actually putting more time to the side, taking less shifts in your job, and start dedicating yourself more to trading ICT. But if you don't even have $500, you need to go get some actual money first, which is the bare minimum in order to actually start trading ICT. The one thing that people don't clarify enough, this is a quote that I've mentioned myself, and I've not seen anyone else mention this quote, so I'm going to claim it's mine. The fast route is the slow route, and the slow route is the fast route. And what I mean by that, the fast route of you trying to trade every single macro, pass that evaluation faster, trying to get funded faster, trying to just speed up the process too fast. You're trying to prove to your friends, your family, other people that you speak to that you are what you say you do. That's not going to get you there faster. Trust me. If that really made more money than the model that I trade, then don't you think I'd be doing the same thing? Trading every single macro, taking low probability trades every single session. That's exactly what I'd be doing if that made more money, but it doesn't. The slow route of taking a trade on Tuesday, skipping Monday, skip Wednesday, skip Thursday because there was no trades. You take 1 trade on Friday as well, 2 trades in the week, one of them loses, one of them wins, you're up on the week. I guarantee over a longer period of time, because I think about 5-10 years, that trader is going to be far more profitable than the trader who takes 5 to 10 trades per session of low probability trades. So if it's not an A+ trade, I'll likely not take anything. I'm not going to engage with price if it doesn't meet my specific requirements, such as a short-term high or low, a liquidity sweep of London, Asia, previous day high, or major buy-side and sell-side confluences, or points of major buy side and sell side in a premium or a discount is very essential. A fair value gap on both pairs, NQ and ES must have a fair value gap on both pairs. Which fair value gap is more high probability? A basic fair value gap or a breakaway gap? For those of you that don't know what a breakaway gap is, when price breaks above the previous short-term high or low for a market structure shift, if price creates a fair value gap amongst the displacement candle, that's going to be your breakaway gap. Pair that with a breaker or a mitigation block, now that's a very high probability fair value gap, and that must be paired with the fair value gap. You must be inside a macro, not 30 seconds or 5 minutes before, not 5 minutes after, inside macro for your entries. Can the model present itself prior or after the macro? Absolutely. As long as your entries are inside of the macro, either the first, second, or lunch macro, then perfect. Then go ahead and take the trade. And this is also a very essential rule that I like to follow myself, is that you must make sure that your lower time frame model of the trade that you're taking there and then does not go against the 5 and 15 minute draw. What I mean by that, the 5 and 15 minute draw for price is when, if you're in a 5-minute bullish gap or a 15-minute bullish gap, you assume that's respected until it tells you otherwise and gets inversed. Therefore, if you're looking for a lower time frame 1 minute short for price to draw to London lows with displaced low on the 1 minute, however, price is now retraced back to a 5-minute bullish gap which we're inside. Where do you expect the draw in the next 5-minute candle to be? It's going to be the next previous high on the 5 minute, and usually 60 to 70% of the time this will happen where 5 or 15 minute will then draw to the next previous high, therefore saving yourself from what? Getting stopped out of the low probably 1 minute time frame trade that you was looking to take. Preferably you want the 5 and 15 minute to follow in the same direction, therefore bearish if you're looking for short, as well as the higher time frame bias which you create on the daily, the 4 hour, the hourly, and now you find the 5 and 15 minute draw. If that corresponds with the higher time frame, now you find a lower time frame model inside macro. Done. That's your trade. Do you need a SMT? Absolutely not. You don't need an SMT. It's not essential. People ask me, is it essential? It's not essential. It's just the cherry on the top of the already existing model. If you have it, you have it. If you don't, it doesn't matter. And guys, stop paying attention to people around you talking about funds. If they're not rich or they don't have any money in their bank account, they're not on a position to be talking about funds. Tell them that to their face. Say, look, you got 5 grand in your account or you got 10k in your account. I don't care if you got 400k in your account. You're in no place to be talking to me about making money. You know, you're going to listen to people who are making actual money, not 400k in their account, 500k in their account. We don't care about that. They're in no position to talk to you about making money, especially if they're not in the field and profitable in the field that you're doing or you're trying to do, which is trading ICT. So cut the noise from anyone unless they're above you at a significant level of what you're trying to get to, which is making $1 million a month, 500k a month, 50k a month, whatever your goal is. Listen to people in that field. When it comes to family and friends, it's difficult because you know you are friends with them or you love your family, but when it comes to making money, stay away from it, and their views on money has got them to where they are. So if you listen to them, they're going to get you to where they are. You need to listen to someone where you want to get to, which is likely not in your friend group, otherwise you'd already be there. Therefore, ensure to learn by yourself, watching my videos or other people on YouTube as well. It's completely down to you, but cut the noise from friends, group chats, family, the lot of it. You need to go monk mode. Social media, Instagram, gone. Stay focused, locked in. That's all you need. And I promise you're going to get there to consistent payouts, but you just need to believe and focus and actually lock in on yourself. And if that is meaning that you have to cut down your shifts on your job, instead of doing 7 to 6 days a week, what I did, I cut it down to 3 days a week, pays for the food, pays for the rent, pays for the basics. I'm not making any money, but I was never making any money from the job anyway. What's the point in saving 1 to 2k a week? In anywhere such as Miami, that's not even going to last you a few hours, a few days in fact, if you're conservative. So focus on the bigger picture, cut the shifts down and focus and lock in. Next slide, very important. If you're trading on prop accounts or live accounts, this applies to the lot, and risk management. I apply the 75% rule to all prop accounts. Let's say you have a standard drawdown of $1,000, right? If you were to drop below $750, which is the 75% of 1,000, then you drop to half position size. If you're below 750, which is 75%, you stay at half size until you get back above 850, which is 85%. And in this case, this is going to give you double the amount of trades in order to blow that account, which would actually equivalent to around 10 trades. If you take 10 losses in a row, then you need to personally contact me on Instagram and you need some serious help. And there's ways to go about it. We can improve and take you out of a mess such as that, but that is a place to come back to the drawing board, scrap prop accounts at that point, and do some intensive back testing for 12 hours on Red Bulls. I'm dead serious, because if you take a 10 losses in a row, there's something seriously going wrong. I've never done that, and the biggest losing streak I've ever had was around 5 to 6 trades in a row. But shortly after, I had a massive winning streak, and my risk management was kept precise and correct. And was I ever dropping below 75%? Absolutely not, because on my prop firm accounts, I like to build a buffer. So once you get funded on these 150s or the 50k accounts, then what you do, you start to scale them up. There's no difference between a 50k account and a 300k account. And you're probably thinking, Milo, what are you talking about? 50k is much different to a 300k. Well, the only difference is the drawdown. On a 300k account, let's say you have a drawdown of around 7,000. On a 50k account, you have a drawdown of around 2,000. So the only difference is it's drawdown. So when it comes to the point of scaling that account, this is why I always advise people to only go with 50k accounts, because they're easy to pass, they're easy to pay out, and once you start scaling them, if you scale a 50k account $8,000 drawdown in profit, then you've got an 8k drawdown, which is the same as what? A 300k account. So you can convert the 50s into 300s, pass them, pay them out faster. Always stick to 50s, they're cheaper and easier to trade. One thing I follow myself as well, 1 to 2 trades a day is an absolute max. If you have one trade at the start of the day, doesn't matter when you took it, and it's a winning trade, that's it. Call it quits, you're done for the day from that point, and you come back for the next New York AM session. If, for example, the first trade you take that day is a losing trade, then you have only one more ticket to look for an A plus trade inside of the next macro. If it doesn't present itself, it doesn't present itself, and you take no more trades, and that's it, you come back for the next day. It does sound difficult to follow and be this disciplined, but trust me, if you're about making money, I'm telling you guys exactly what you need to follow and need to do. Most importantly, macro timings. Your entries must be inside of these 3 windows. These are the 3 macros that I only trade. I don't trade any other macros. Recently, I've cut out the PM session because it's low probability and doesn't tend to move much. The London macro, I don't tend to trade it because for me, it's going to be around 4 a.m. and I don't like to trade the London session. It doesn't tend to be and produce the best trades. So I only stick to the New York AM macro, which is 9:45, 10:15, 10:45, 11:15, second AM macro. And then we have the lunch macro, which is 11:45 to 12:15 p.m. Inside of the lunch macro, if you was to have a massive run up in the AM, what do you expect in the lunch macro? Either prior to lunch macro, already a previous run on sell stops, or inside a lunch macro, you can look for a short after we've swept a point of buy side. We tap a higher time frame imbalance, and then you can look for a short to target discount of the AM, or if we had a rundown, then a premium of the AM, if that makes sense. Or you could look for a continuation. There's many models that you can trade inside of lunch, but usually it's going to be a run on stops. And the unicorn model, in brief terms, what it is a breaker paired with a fair value gap, and that's going to be your unicorn model right there and then. But without other confluences, this is not going to be a model or a trade that you're going to look to take if, say, for example, it's not inside a macro, you've had no displacement, etc., etc. So understanding premium and discount on the higher time frame, along with your higher time frame bias, is very important. You can use this using the Fibonacci tool. You only need 0.5, 0.62 on your Fib tool, nothing else. I see people with 0.32, 0.79, 0.798211. Like, you only need 0.5, 0.62 to find whether you're in a premium or a disc. That's it. Lower time frame and higher. And guys, I've made you an essential checklist to follow. Screenshot this, take a photo, whatever, write this down. Must be inside of macro. These are must for a trade. It must be inside a macro. You must have a sweep of liquidity. Asia, London, previous day low, etc. Other points of buy side can also be applicable for the trade, as long as it meets with your directional bias. Market structure shift with the body closure above or below the previous short-term high or low, whether you're looking for longs or shorts. A fair value gap must appear on both NQ and ES. It's essential. And either a breaker or a mitigation must be paired with that fair value gap on either NQ or ES. It doesn't have to appear on both, but as long as one breaker or mitigation is paired with either pair on that fair value gap, then you can look to take it. And price is not tapping into an opposing 5 or 15 minute fair value gap going against your lower time frame model. So you're looking for shorts, we better not be trading into a 5 or 15 minute bullish gap. Otherwise, I'm not going to look to take that trade. Must align with higher time frame bias. Never trade against your bias, because you've determined the next daily or 4 hour candle is going to draw lower. Why are you going to look for longs? It does not make any sense. That's a bare minimum. If it's super clean, maybe a 1.7. This is a bare minimum on a trade example. And then, as I said, an SMT is not essential. You don't need to look for that. That's just being too picky at that point. But if you do have an SMT, there you go. That's another confluence to that trade. So guys, now we're going to get into some summer price action, because what's coming up, we have obviously the summer months coming up. So I'm going to prepare you guys inside of this video a example of a very clean summer month trade inside of July last year that I took myself. It's live on YouTube. Go ahead, feel free to watch. Let's get straight into it, guys. Right, so let's take a look. This is a live trade example of a trade that I took personally myself back in July of last year, because we're preparing for the summer months. Let's get straight into this breakdown. A few people have mentioned as well about Liverpool t-shirts that I'm wearing in the videos, which is quite funny because I don't even watch football, but I chose to wear the Liverpool t-shirt because it's a good fit and they just so happen to win the league again. So be it. I do watch football here and there. You know, Barcelona, Real Madrid, they play today and I'm pretty sure Barcelona won. But when it comes to watching football, I only watch football if there's money on the line. I'm actually going to bet on it. My most recent bet went tits up and I lost £30,000. So as far as football, I'm not really too interested in it at the moment. I managed to recoup those funds from the loss on that football betting match by playing roulette shortly after and actually having a winning day after that, and I called my betting career off at that point and went back to trading ICT. So now let's get straight into the part that actually makes us the money. On the daily time frame as of now, where would you say the next daily candle is likely to draw to? Well, by looking at things as of now, we traded back into the most recent unfilled daily bullish gap. Therefore, I see the next daily candle drawing higher towards this previous high as the overall draw at 29.80. So now let's work down to the 4 hour time frame and let's understand where is price likely to draw to now on the 4 hour time frame. So by taking a look at both NQ and ES, you can see ES has inversed the 4 hour bearish gap and now drawn already to the previous high of equal highs and has been taken out. Therefore, the draw is more 50-50. We've taken out equal highs on the higher time frame, the draw could be lower, or we could draw back to the previous high. It's more 50-50 at this point, and there's not a very clear direction for bias. However, on NQ, price is currently trading inside of a 4-hour bearish gap, which is filled over 62% already. We've taken out this previous high, and we've traded back into this 4-hour bearish breaker. Therefore, the overall directional bias, as of now, on the 4-hour time frame, is sitting more or less 50-50 because we've traded out of a 4-hour bullish gap. But I understand the overall draw out of this 4-hour bearish gap is likely going to be lower towards this previous low. So what you can see so far, we have the daily as bullish, the 4-hour as bearish. So far, I'm leaning on a neutral bias. So now let's take a look at the 1-hour time frame, understand where is price now likely to draw to on the 1-hour time frame to get more of a clear bias. So by looking at the hourly time frame as of now, this current hourly candle is open and it's very obvious. We've traded back into the most recent 1-hour bearish fair value gap and taken out Asia highs. Therefore, I expect the next hourly candle to be the draw on this previous low here, which I believe, by the looks of things as of now, is going to be London lows. And now we look to mark out the key levels of London, Asia, previous day low, high on the 15-minute time frame. So now on the 15-minute time frame, let's mark out Asia, London, etc. I'm going to mark out Asia just to identify that we have already taken this level, so we're not forgotten that we have taken that level out. It was previous equal Asia highs, as this high almost took it but didn't, and then it got taken out at the New York Open, therefore indicating already a Judas swing. So a Judas swing is when price opens at the New York Open, goes straight for a point of liquidity, and then has an immediate reversal back to the New York Open price. So by looking at NQ and ES as of now at this previous high, what is one thing that you notice between NQ and ES? This is plain obvious right in front of us, is that we have a bearish higher time frame SMT on NQ as we traded out of that 1-hour bearish gap resting above Asia highs, therefore indicating lower prices now on NQ. So now let's look on the 5-minute time frame and understand the overall draw on the 5-minute, which is currently unreadable. It's difficult to say where the next 5-minute candle is likely to draw to. We're not in a 5-minute bullish or bearish gap on either NQ or ES, therefore there's currently no reason to expect a draw as of anywhere. So Asia highs and lows runs between, you want to mark out Asia between 8 p.m. and 2 a.m. New York local time, and you want to mark out London between 2 a.m. and 5 a.m. As of now, you can see Asia highs has been taken on NQ. As far as ES already took out Asia previously, and now it's taken out this other previous high. Therefore, you also want to mark out data highs and data lows. And in this example, you want to look to mark out data lows and highs. On this specific day at 8:30, we had a set of red folder news come out on this day, and this is going to mark data lows as it's not already been swept, which is going to be an overall draw for this macro as we're leaning towards more of a bearish bias for a draw on data lows after taking out Asia highs on NQ and ES. Okay, so now we've marked out the key levels, we understand the draw. We're going to wait until macro at 9:45, 10:15, and we're going to look to see if we get a displacement lower for price paired with either a mitigation or a breaker on either NQ or ES, not trading out of a 5 or 15-minute bullish gap, and then look for a draw for data low. Okay, so as you can see here, we're now inside of macro. I can delete this line off, and price has inversed this bullish PD array, which is, when I say PD array, it's going to be fair value gap, breaker, mitigation, order blocks, anything bullish. This bullish fair value gap has now been inversed for price, therefore showing that bullish PD arrays are getting disrespected and bearish are getting respected. We've then further seen a market structure shift below this previous short-term low, which on ES has created a bearish mitigation block from this Wicks low paired with this bearish fair value gap. And also on ES, we've seen an inverse of that bullish fair value gap for price. So an inverse of a fair value gap prior to your trade is not essential, but this is one thing to note as we are seeing weakness in bullish PD arrays getting disrespected, therefore a shift in market structure. A shift in market structure can be where price displaces below the short-term low, which is the essential shift in market structure. But other shifts in market structure is when PD arrays such as order blocks, breakers, mitigations, fair value gaps, opposing get inversed prior to your model forming. And then we're going to look to enter off the first presented gap, which is this fair value gap. Price has drawn back up to this fair value gap on NQ, and it was a few ticks off entry. However, ES has already tapped the fair value gap and the mitigation. Therefore, you're going to look for an entry right away as we're only a few ticks off, and that's where I took my entry. As ES tapped into this gap and tapped the mitigation, I was already on NQ from that point, as the stop placement is 100% valid. So my entry was just slightly below where we wicked to the previous high. Stop placement for this example is going to be above the mitigation, above the fair value gap, therefore 26.5 handle stop is entirely valid, and we're going to look to run our TP at data lows. Okay, so now we've caught an entry on price at this area here. Obviously on the backtesting example which I'm showing you here, our entry is obviously going to be slightly out, but on live price action my entry was around 64525, a few ticks off that fair value gap on NQ as ES trades back into that gap. Stop placement, for example, is going to be at 26.5 handles, and our TP is going to be resting just above data lows. The reason why I run my TP above the objective or below the point of buy side that I'm looking to target is because in case price creates equal lows, I'm still going to get filled for price. For the sake of a couple handles, there's no point trying to risk the whole trade going back to break even as of that point. So I've been doing this ever since I started trading, and I always look to target a few ticks above data lows in this example. And then once we create a previous short-term low and that gets taken out, then we can look to move our stops towards break even. Right, so now price has taken out this previous short-term low, as you guys can see there. Let's mark that out. This is going to be a point of break even. So when price creates an internal short-term low or short-term high, depending if you're long or short, then once that gets taken from your point of entry, then you initially go straight to break even every single time. You don't move your stops to the previous short-term high or the short-term low if you're long or short. You always move stops to break even, because around 80% of the time, if price is coming back to take you out, it's not going to come back and hunt stops at break even, because that's not where everyone's stops are. Stops are resting at previous short-term highs and lows. What's the point in wasting handles, wasting profit on the table by putting it at a short-term high or low? At this point, you might as well put it at break even, and then as the trade progresses, then you can start to rest it at points of short-term highs and lows in a profit along the way of the trade. So as of now, we're going to move our stops to break even, which stated earlier is going to be at 64575, which this would have been my live entry example. So now it's break even trade, and let's see how the rest of this trade plays out. So every bearish confluence, such as this bearish gap, should get respected in an algorithmic market. In an algorithmic market maker sell model, should get respected all the way towards the final objective of data lows in this example. I had it marked out as data highs, but it's data lows in this example. So this is also another reason why you shouldn't trail your stops too aggressively to the previous short-term high. I always like to move my stops once price takes out this short-term low, then I'll trail it to the other short-term high. If we haven't already taken out market structure and the previous short-term low, then I'm not going to trail my stops until we take this low, then I'll trail it to the other short-term high. Otherwise, you can very easily, like this, get prematurely taken out of a trade whilst it's still valid. Okay, so now we've taken out this next short-term low, I'm going to move my stops into a profit at that previous short-term high. And there you have it. Our TP was smashed and we secured 72 handles on this trade. This was a lovely AM session example in the middle of the summer. Hopefully you guys have enjoyed this breakdown of this trade that I took back in July of last year, preparing you guys for the summer ahead. We're going to make a lot of money without a doubt. Don't think just now during the peak months of the year to trade is the only points you can make money. We make a lot of money through the sun months and all year round. Stay patient, stay disciplined, and only trade that one model. And I promise this is the only model you need in order to become profitable trading ICT or any concepts in general. And for those of you that have recommendations for the next video or questions, in fact, make sure to drop it in the comments of this video. And until next time, have a great rest of your weekend, and I'll speak to you guys tomorrow for the AM session.